Hi, Steve.
Hello.
How are you?
All right. How are you doing?
Good, thank you. We're just waiting for
Waiting for a shash.
Yeah, should be on a set.
Make sure my volume is good here.
Can you guys hear me or see me?
I can hear you. I have a bit of an echo.
Okay. How about now?
Perfect. I see you. Okay, so here we are.
There we are. All came at once.
There we go. Well, good morning, everybody. My name is Cathy Cunningham, and I'm a manager for the Untitled Chapter. I'm joined by Stephen, who's a senior vice president for the regional director of Rubinstein, and also Harry, who's an advisor in Rubinstein's debt investments group. Good morning, gentlemen. How are you today?
Great, Kathy. How are you doing? Is the sound all right? There's a little bit of an echo when you're speaking.
There is an echo. Let me see if I can. Is that better now?
That's better.
I wonder what happened there. Sorry about that. So once again, good morning. As everybody who's watching, if you have any questions for Stephen or Rashesh, please submit them today via the Q&A function at the bottom of your screen. We'll get to as many questions as humanly possible today. So before we get started, this webinar is obviously focused on the DC market, but I know that Rubenstein is active in multiple markets. So Stephen, perhaps you can give us an overview of both your debt and equity practices.
Yeah, why don't I give you a quick overview of Rubenstein Partners and then roll into the equity and the debt vehicles that we have.
That sounds fantastic.
We've been in business for 50 years. Some of the prior companies still included members of the Rubenstein family. David Rubenstein and then his son, or Mark Rubenstein, started the company 50 years ago, and then David's been with the company for a very long time, more than 30 years. And originally starting as an operator doing value add office, we really only do office. We, about 15 years ago, changed more to a fund platform, and we've raised a series of 3 funds totaling about $1.5 billion of equity. And our footprint is primarily East Coast, with 6 offices up and down the East Coast, like New York, Washington, Raleigh, Atlanta, the major markets up and down the East Coast. And then on the debt platform, we raised capital about 3 years ago, and Ashesh, maybe you can give a quick overview of the debt platform.
Sure. Thanks for that, Steve. We launched Rubenstein Mortgage Capital in 2017 as a vehicle to essentially leverage our expertise of transitional office and office construction in throughout the United States through first mortgage loans. So I think to date we've been very active, particularly in the DC market, and we most recently closed a loan in Reston, which was featured in Commercial Observer a few weeks ago.
Heard that publication. Great. And Ashesh, maybe just for our viewers' kind of understanding, when you started your debt practice in 2017, was that responding to avoiding the marketplace? Obviously, it was a competitive time. So what opportunity did you see back in 2017?
Sure. So that's exactly right. We saw an opportunity, I think, as a borrower, and I'll ask Steve to chime in here since he was probably reviewing a lot of term sheets at that time as well. But we saw an opportunity where banks and even the debt funds at that time were not meeting our needs as a borrower, and we saw an opportunity to provide investors with a solid return, as well as to provide borrowers with a lender who understood their business plan a little more closely than your average lender.
Right. Steve, do you want to chime in there? What was kind of lacking for you in terms of the financing sources that were available to you in 2017?
Well, what happened is it just sort of slowed down and dried up. I mean, there was more regulation on the banks. So with what we were originally able to capitalize and finance when we started our first funds, it just got harder and harder and more difficult. So sponsorship was key, and the asset was key. But what we saw is just this void that Shesh mentioned, and by formulating our own platform, we not only could balance like what we were unable to find, but we understood that as a borrower ourselves, and then we created this vehicle so that other borrowers, we understood the predicament they were in as we provided this debt capital.
Right, absolutely, that makes sense. And we obviously speak with a lot of owners that are also lenders, but maybe Shesh, from your perspective, what is the benefit to being both an owner and a lender when you're out there in the market competing for deals?
Sure, I think for us, it's really knowledge of our markets and understanding what needs to be done, particularly in the transitional office space, in order to stabilize the property. So when we're thinking about the DC market, I have no problem picking up the phone or talking to Steve Evans about, his thoughts on the exact property we're looking at. And we'll take Reston Metro as a great example of that. Yeah. When that came across our desk, Steve was, he kind of chuckled when I sent it to him, and he said, Shesh, it's one of these properties that we've looked at and underwritten deeply. So for us, it just adds another layer of certainty and not certainty, but a layer of confidence in our underwriting that many lenders may not have.
Right, absolutely.
Steve,
and also, sorry, go on.
No, I was just going to turn it to Steve. So just thinking about Reston Metro, what were your thoughts when I passed that idea on to you?
Yeah, I think I kind of chuckled as Shesh mentioned, because we had one of our investors had a 1031 investment requirement. So we had spent a lot of time on that as an equity acquisition. And so when we weren't successful in making that investment, we kind of put the file down. But then Shesh, when he called, I'm like, we've done a lot. And I think that kind of just relates to how having the dual-pronged equity, debt, collaborative atmosphere that we have at the company, which really isn't always the case. A lot of times it's just silos. You don't talk to your kind of debt or equity silo. But we found in our, at least in Rubenstein Partners, and I think more personal wise, by collaborating, we've had a much higher success rate in terms of placing debt investments specifically.
Right. I bet it also kind of adds to your speed of underwriting as well. If you're familiar with these assets and you know them kind of inside out, it must help a lot. And just for our viewers that might not know too much about the transaction, Shesh, maybe give an overview. It was a $29 million loan, correct, on Reston Metro Center 1?
Right. Just a high level, it was a vacant office building along the toll road that was bought out of special servicing, and we were able to come and help finance the new buyer's acquisition, as well as provide good news money for leasing costs. I think the pros of that transaction, as Steve mentioned, is we were familiar with the asset in advance. We also understood the market, having purchased and several assets along the toll road. I think most recently one a few about a mile down the toll road. And the third thing was we were familiar with the sponsor, so we knew sort of what the business plan would need to be in order to stabilize and attract tenancy. So we were able to, this actually was a transaction that came to us right around the time of the stay-at-home order, because of our confidence in our
I think you might have frozen. Steve, can you hear me okay? Yeah,
Yeah, I can.
just a shush.
Can you guys hear me okay, or
Now you're back.
did I go in and out?
Here we go.
Oh, no.
Oh, no worries. It happens to the best of us. So,
Where did I cut off, Kathy?
you were just saying that you had your confidence with the asset, and you kind of cut off after that.
Sure. Just I'll just sum it up. Our familiarity with the asset, the sponsor, and the submarket helped us evaluate the business plan even during sort of the initial stages of kind of the stay-at-home order. So even though there was market dislocation, we felt confident in sticking to our terms and our underwriting.
Right. And how's that experience in closing that loan during the pandemic? I guess you had most of your ducks in a row beforehand, but how was that experience for you?
It was definitely a new experience. I have to give take my hat off to Steve. He's our boots on the ground in DC. So when a lot of us were kind of shut in and not able to travel, we had Steve who was able to tour the property and observe social distancing, and also help facilitate a lot of our vendors who were third-party report. We're trying to complete third-party reports during that time. So
it's handy. Now, just for a broader kind of picture, so how long has Rubenstein been active in the DC market, and why does it appeal from an investment standpoint?
Well, actually, I worked for the predecessor company back between like 2000 and 2003. And I ran development, and so many members of the executive and senior management have been active in Washington since that time. And so we were developing, buying, and then selling properties in the predecessor company. And then when we turned to the fund business, we started, we continued to buy assets since about 2005. And over the last 14 years, we've bought probably 2.5 million square feet of office buildings, some of which we've harvested value by selling, some of it we're still implementing our business plan. And then our debt vehicle, I guess, Ashesh, we've got 4 investments and 3 of them are in Washington. So it kind of is a testament to what we think about the market and how the team really works together to find opportunities and successfully implement.
Absolutely. So Steve, you've been, very active obviously for a couple of cycles now in DC. So how would you say that the DC market has evolved since the previous crisis, and how do you see, its recovery kind of prospects from this particular one?
Well, I went back, admittedly, with some of the questions the 3 of us were talking about to try and figure out what went on during the last cycles. And I'm looking off to the side because the good thing about Zoom is you can make a couple notes.
Right.
But we had the S&L crisis. We had which DC got bailed out with Office of Thrift Supervision and the RTC. So the government kind of helped a lot in terms of leasing office space and stabilizing. .com bubble, like tech companies came, but it was really more government-backed tech companies. So once again, the government kind of acted as a stabilizing factor. And then even with the Great Recession, the federal government was involved, but really you just started to have the tech explosion with Facebook and Google and Amazon, is the big one that obviously we all know that they've got HQ2 here. So I don't know, so DC has been fairly resilient. And right now, I'm going to be the first one to admit that it's very unclear what will be the driver going forward. But, defense is still pretty strong, and health is obviously trying to find a vaccine for the virus, kind of supports Maryland, which is where NIH is, and that's where most of the driver in Maryland. So it's not like clear, but it's kind of fuzzy that we're going to come out of this better than a lot of our other cities across the U.S.
Right. And that's actually like an interesting comparison to me, because obviously, you know, we're based in New York, but DC is one of our core markets too. But what do you think are the pros and cons of New York versus DC from an investor standpoint?
I think from an investor standpoint, returns historically are lower. So Washington offers higher risk-adjusted returns typically. And when I say Washington, I am thinking about Washington, D.C. proper, Maryland and Virginia, sort of the D.C. metro. And Washington probably has a more diverse economy, although I'm sure that would be argued by New Yorkers. And I'd say there's just a more diverse lifestyle, density, urban, suburban. It's, you know, since it is more, New York's compact, but DC still kind of compact around the Beltway, offering a lot of different options and opportunities. So I think that even though we have similarities, DC just is poised to do pretty well relative to these other big cities. Although downtown DC, just like downtown Manhattan, I mean, it's going to be a challenge because of the pandemic and the sort of the wonderment as to how dense people are going to be comfortable in office buildings, riding public transportation, and all those factors.
For sure, yeah, it's definitely a thought for me. Is that, you know, I work in an open office and then take the subway every day to work. So certainly, I kind of, you know, daunting thought of going back to that lifestyle again. But Ashesh, from your perspective, obviously, you know, I think every market right now is, or was before COVID, pretty competitive from a debt standpoint. But how are you viewing New York versus DC when you're out there bidding on deals?
Well, I want to be careful what I say because I don't want all of our New York listeners to start logging me off. But, you know, I think generally speaking, you know, I'm going to say a little bit what Steve said differently. You know, in DC, we do see and have access to more submarkets in the suburbs closer to the residential areas as a lender versus what we're seeing in New York. And for us, it really comes down to tenant profile. You know, obviously DC is driven by the government and its contractors. Most recently, we've kind of seen a surge of tech in DC, whether it was Amazon Web Services out in Herndon to HQ2 and National Landing. New York, when I think of New York, obviously financial services are at the forefront, but in recent years, they've also seen their own tech boom, as well as you know, co-working has really emerged as a large user when we think of the office space. So when we look at how, as a lender, when I look at how resilient a sub-market can be, I want to look at the health of those individual industries. And as Steve mentioned, you know, when we were looking at Reston, we looked at closely how the government had reacted in previous downturns. I think when we were looking at New York versus DC for future lending opportunities, we're looking at, you know, the health of the financial services industry. How's co-working going? How are those tech companies using their space? And then, you know, one data point we've used as an early indicator internally is really collections. Obviously, not only within our own portfolio, but how major market players and landlords are performing on collections. So in DC, we look at public REITs such as JBG Smith and corporate office properties, you know, and their collections are in the high 90%. New York City, you know, again, relatively speaking, is doing well. SL Green, Vornado are in the 90% range. Empire States and call it the low to mid 70s. So I think that's a, you know, that's an indicator for us just to, as a starting point, and then obviously we look at it on a property by property basis.
Right. And in terms of collections, you're just generally speaking, Steve, how are your office tenants fared during COVID?
I have some psychology background in my education, so I'm going to answer both the technical answer as well as kind of an observation.
Great. Yes.
I characterize it like 3 months was kind of about the time period when this started and when DC, Maryland, and Virginia have started getting into phase 2 and phase 3. And then, everybody, in terms of at least 50 to 75% coming back to work.
Right.
Mathematically, we've kind of been in the 95% range for our office tenants. And that we've gotten to the 95%. And, the first month it was a struggle. We had to call some. Second month, we called a little less. Third month, we called even less. And frankly, I think in the third month, once it was evident that the market was going to be reopening with these phases, like several tenants said, okay, we think we're going to be in good shape, so we're sending rent. So that's kind of the math, mid-90s, even a little higher. Kind of if you just step back at the macro level, it was interesting that there'd be like 3 categories of tenants. Clearly the restaurants, hospitality, I mean, they were and are still struggling incredibly. We have one property in Washington, for example, where, some can't pay at all, some can pay their operating expenses, and then some are in good health, like a Starbucks, but they're trying to figure out their own situation. Then you have the mid-level type tenants where they were kind of genuine. They'd say, we're not sure what's going on. Can you help us? We had a dialogue and we worked with those. And then we had a group of tenants that were really just kind of like taking advantage of the situation and just sort of like not paying rent to just not pay rent. And then once we came out of, once the phases started becoming more apparent, everybody kind of caught up. So that's kind of the psychology of the kind of 3 different categories I would comment.
Yeah, absolutely. And we've heard a lot about some of the tenants that can pay but chose to try not to. So do you think that the relationships between them and their landlords going forward are going to be slightly different, given that they, kind of tried to take advantage of a bad situation?
I think if a landlord was not cooperative and didn't lend an ear and didn't communicate, I could see that being a strained relationship. But we did try very hard to speak with all of our tenants. Sometimes we reached out proactively, sometimes we just responded to their inquiries. But I think if you show collaboration and empathy, I think you build a much stronger relationship. So that's kind of the goal we try to do corporately as well as in Washington.
Absolutely. Now, Ashesh, in terms of the borrowers that you're working with, did you have a lot of forbearance requests during the pandemic?
No, I think in that respect, we were fortunate that we've had very good borrowers and stuck to the terms of the agreed to loan.
That's good. I think you're definitely in the minority. I think a lot of lenders have had them, so that's good to hear. And now, given that your portfolio is primarily office, Steve, first of all, do you have any potential office acquisitions in your near future, or how are you looking at office acquisitions going forward, given that our kind of ideas around how we're using offices are now kind of changing thanks to this pandemic?
Well, we're definitely still active on both the equity and lending side. There's been almost a complete drop off of sort of marketed investment opportunities. So what we do in those situations is we revert to the proactive. We're always proactive, but now we have to be more proactive. So we basically try and identify those owners and or tenants that take up a large portion of a building that are in financial distress. Maybe they're even bankrupt. And right now we have 2 opportunities that we're very focused on in the DMV here. And we're hoping that one of them in particular kind of ripens. So while there is less kind of, pick up the phone opportunities, that's typically not what we're doing anyway. It just shows that the proactive person is finding the acquisitions, and frankly, that goes for leasing too. So if we want to get the buildings leased, we've got to be proactive too. But they're out there. They're just few and far between. So you've got to actually uncover heavier rocks than you had to uncover previously.
Right, that makes sense. And Steve, are these distressed opportunities or slightly distressed, or how would you describe them, the ones that you're looking at today?
Yeah, I would say they're distressed, but still nobody is selling at distressed property or at distressed pricing. So
Right.
what you have is somebody would prefer to hold until like the market recovers or there's more visibility with the coronavirus, but they really can't. So the distress is that they're more forced to sell versus like the price is, a substantial discount from what it otherwise would be. It might be a little softer, but it's not substantial.
Right.
But to be clear, for good properties, we will make an investment based upon the underlying fundamentals. So while we would love to have distress and properties at lower pricing, you want to make a good investment that will do well long term. And those properties don't really have distress because owners and lenders don't kind of give them away at distressed pricing.
Right, absolutely. And Ashesh, are you seeing any market opportunities on the debt side today, or do you think it's still a little bit too early for any real distress?
It's funny that you mentioned it. I would have said yes, probably a week ago, but it looks like some markets are returning, so we're seeing increased competition. I'd say in terms of the opportunities we are seeing today, we're seeing sort of things that fit our traditional transitional office bucket, but I think prior to, recent weeks, we had also been seeing properties with better credit profiles, whether that meant longer term leases in place, lower loan to cost requests, just better credit tenancy even, or even better located, more trophy assets. We're seeing now the market sort of return, more lenders are getting that liquidity back. So we're seeing more competition for those opportunities. So I would have said, yes, there are still opportunities that we're actively pursuing. Probably not as many that were out there a few weeks ago. To build off one of the points that Steve brought up, though, I think there is going to be a second wave, not necessarily of distress, but you are going to see opportunities that maybe Steve's underwriting right now on the equity side. If we don't get those on the equity side, we will then we can turn around then and potentially quote it on the debt side. So one unique feature of our platform is we essentially can have two bites at the apple, just in different vehicles.
Absolutely, that makes sense. And Ashesh, do you think that we'll see more activity in the kind of distress side when the 90-day forbearance runs out for a lot of the borrowers, not your borrowers, but other borrowers in the market?
I think there could be. I think it really depends on how lenders are looking at office within the context of their greater portfolio. Speaking to some of my, kind of people in my position at other firms that have diversified portfolios, I think there is a sense of, their attention is on properties outside of the office space that are facing distress. So within their portfolio, they're using office as a barbell to actually give their overall portfolio better weighted performance. So again, that's anecdotal, but we haven't seen it yet, but we are open to looking at those opportunities, and we are keeping our eyes open for those opportunities.
Right. And Ashesh, just for our viewers, so obviously, Rubenstein is known for its office activity, but on the debt side, are you also just focused on office, or are you open to other asset types?
We're generally only office. We do have a mandate to look after industrial or flex, but just given our cost of capital and how efficiently those markets have been financed previously, I would say our bread and butter is office.
Right. Now, Steve, in your existing portfolio, are you making any tweaks to your current properties in light of COVID? Any, are any tenant requests for changes in the layout of the office, etc.? Or
yeah, we're doing a lot of different things. I guess I'll preface it by saying, I've got family members who are distance learning and working from home, and we're an operator of office. So I pretty much went to our properties every day, give more freedom to my family. And I'm being politically correct. If you can read between the lines, it was better for me to go to our properties. But what that also did is it allowed us to really focus on what our tenants were doing that were going to the office, and what we would do to our properties ourselves to like anticipate a higher return to office and greater density. So over the last couple months, we've been doing a lot of different things physically, electronically, trying to just make our office properties more safe, if you will, so that the tenants coming back and even our own employees feel like they have a safe environment. And those are sort of the initial tweaks we've been doing to the property. And then we're doing just some other things for marketing. When we do space planning and design, we're trying to assess how tenants and even ourselves will be using office space in the future, and how that's going to impact occupancy density within the tenant space, as well as within your just overall building.
Right. And see, what are some of the key changes you've made in your properties? I think a lot of people just now are kind of starting to think about going back to the office, some of the things that will help them to feel safe. We certainly are as a company. So what are some of the key things that you've done and maybe tenants have requested?
Well, I think one of the buzzwords and what everybody's trying to do is make as much of your building touchless as possible. So we're doing that where practical, cost effective, implementable might not be a word, but everybody's trying to do this. So to convert infrastructure like front doors and restrooms and interior doors to touchless when like the whole world is doing it, it is challenging to try and get enough equipment to do that. So we're trying to be strategic if we can't execute that on all of our properties, on all floors, et cetera. So there's those sort of physical changes. Then there's just more technology we're trying to implement so that maybe people can, utilize an app or other things rather than having to have necessarily the same level of interaction that they had previously to book conference rooms or meet with our engineers or meet with our property managers or have a tour with our leasing team. Just putting in more IT infrastructure so we can have Zoom meetings like we're having here. Not like that's what we hope we return to normalcy, but in the meantime, you've got to figure out, backup plans. So we have backup plans to backup plans.
Yeah, there's so much uncertainty still that we don't know what's going to happen in the fall, resurgence of the virus, who knows, but I think it's definitely a wise move. Now, I have a couple of questions here from our audience. How will modern building technology, such as power security, IT, Hvac, and the recent advancements of the ability to integrate these technologies on an open platform evolve the traditional investment analysis of an asset?
Ashesh, you want me to take a crack at that?
Yeah, I want you to start this one.
Yeah, I guess the other thing I didn't mention is, many people are focused, many tenants as well as ourselves. We start, what do we want? And then what do we want as a company? Because that's what tenants want. So I didn't mention really HVAC. People want healthy buildings. So whether it's cleaning or trying to make changes to the HVAC like this person has asked, we're trying to either have more fresh air, more filtering, more air turns. But we admit there's physical challenges to a system. If it exists, it can only do so much. So that gets back to your use of the word tweak. We can tweak things, but we can't necessarily change it quickly or cost effectively. So that's what we're studying now. Now, I guess the specific question is on the investment analysis of an asset. I mean, technology just allows us to evaluate an asset better. I mean, whether it's Argus or Excel or just data we can get from our building systems. So, I mean, if historically you had to go and spend 3 days studying operating expense history, now we can download some of that from our kind of the technology we have in place. So technology helps our analysis, but it still involves people, interaction, studying, et cetera. So it's, still needs people. The computers can't do everything for us, fortunately.
Thankfully, right? We'll have a job.
Yeah.
Another question here from the audience. What do you think about life science and pharma research real estate opportunities, particularly in suburban Maryland?
Well, I guess since we have two assets in Maryland, sometimes we're contrarian thinkers. So we did invest two office buildings in the 270 corridor. And I won't get into the details of the whole thesis, but what we are clearly seeing right now, because of the tenants that are actually in our buildings, they have high occupancy during this COVID situation because they have gotten new contracts to either test vaccines or to test antibodies. So we have two tenants in particular. Three. One is actually a company that is a group of doctors that is emergency medicine. So they're out in the field. Basically putting people on respirators as emergency medical doctors. We have another company that basically has exploded because they have testing from another country that gets shipped in, and it's still office space, but their headquarters is here, and they're always in the office and getting lots of deliveries. And then the third company is similar, in that they're doing sort of healthcare evaluation. So in Maryland, we're seeing a material pickup in both office and lab related users, although we're just focusing on the kind of the office type user.
Right, absolutely. And do you think that the life science space is something you want to do more in going forward? It seems to be very well insulated, especially now post-COVID, or mid-COVID, I should say. We're not really out of this yet, but is it a space that you want to do more in going forward, would you say, Steve?
Well, to the extent it's just the office component, we're not a lab investor. In our predecessor company, we did own a big pharmaceutical campus in Radnor, Pennsylvania, and most of that was office. So I think there will still be an interest in some of the life sciences, but more for the office. And we also like the diversification. So it's important to us to have diversity rather than putting all your eggs in kind of one industry basket.
Right. Absolutely.
It does ebb and flow as to what industries are up and down in any given sort of year or cycle.
Right, for sure. Yeah, definitely. Now, in terms of DC submarkets, which to you are the most interesting right now in terms of investment or just a general activity there? What do you think are the most appealing neighborhoods or submarkets right now?
We're submarket agnostic for the most part. We look at all submarkets. Now, certainly there are some submarkets that just kind of are, quote unquote, easier to get your arms around and easier to invest in just because there's more diverse fundamentals. But I think right now we're looking really Northern Virginia, out the toll road where the demand drivers are. We're looking around the Beltway, both in Maryland, Montgomery County in particular, as well as Arlington, Fairfax, and Alexandria. We tend to stay closer to DC Metro. We do spend time. Baltimore kind of comes under our purview. We'll look at that, but that's kind of an example of a submarket we look at, and the other Baltimore submarkets, but it's a little bit harder to see the long-term growth. So I think we look at all the submarkets. It really comes down to, like Ashesh started with, like the tenants. It's like, if I were the CEO of a company, like where would I want to set up my company and why do I want to go to that building? Right. And sometimes it's cost effectiveness. Sometimes it's, I need amenities because, of a certain reason. Many times it's always amenities. Sometimes, it's public transportation. Maybe that was pre-COVID because people are more afraid to ride the public transportation. But, is it access it? Is it like where's the executive housing? You really drill into why that building? Because there are a lot of largely empty buildings all over America, and it's really critical to just focus on, why that building.
Right, that makes sense. Now we talked about acquisitions, but in terms of dispositions, so last year you sold the Centerstone at Tyson property. So I wonder if you could talk us through, why was the right time to sell that asset last year, and how you're viewing dispositions today.
Yeah, that's a great example of, the macro submarket was Tyson's, so that's kind of an easy one for most people to understand. The particular location within the submarket, many people, in my opinion, didn't understand it.
Okay.
And we made that acquisition, well, let me follow. They didn't understand it. Now, just as an example, that building happened to be one of the closest office buildings to my home. So I know all the back ways to get around Tyson's. And the thesis there was something that ultimately panned out, which I'll get to, but it just took a little longer. So while we were waiting, we bought this empty building, great newer building, very efficient, big block of space in Tyson's Corner, great for a corporate user. You had Gannett over there, Hilton. Our expectation was we'd find a corporate user and lease it up very quickly. Took a little longer, but then Freddie Mac came in, leased the building for 12 years, basically exactly what our expectations were when we leased it, just took longer. So the reason we sold it is we signed a Freddie Mac lease. There was some free rent. We capitalized that for the buyer and then sell this really solid asset with an investment grade tenant, at a great time in the market where you can't get any kind of coupon clipper to a foreign investor. So the timing was really because we leased it.
Yeah. And how are you viewing any potential asset sales this year? Do you think it's a bad time to sell, or what is your view of these potential sales?
Well, sort of the way we started was, we tend to buy buildings with a lot of vacancy, and then we fix them up, and then we lease them, and then we sell them. Right now, we are considering selling one asset that we haven't leased. We think the timing is right based upon a couple of interested parties that have said, I want to do something with that asset. It's a little different than what you would do. So the timing and the pricing is right for that. Otherwise, our other assets, we still want to implement our lease up program a little longer than we projected originally, but we don't think the timing is right now unless there's kind of unless there were, we landed that larger tenant that we're focusing on in several of the assets that we have.
Right. That's great. That's fantastic news to know there's interested buyers and the pricing's good. Now, in terms of, the rest of this year is kind of hard to think about given there's so much uncertainty. I think uncertainty is kind of the buzzword I hear in every single call right now. But how are you looking at the rest of 2020, both from a, investment standpoint, from a debt standpoint, Ashesh, for you? Can you make any plans for the rest of this year?
You want to hit it first, Ashesh?
Sure. No, I think we have discretionary capital and we're actively looking at new loan opportunities, and we'll close on them if they make sense from a risk-adjusted basis. So I think it really comes down to what the borrower profile is, what the asset profile is, and if it seems to fit our platform.
Right. Steve?
Yeah, I think we're basically opportunistic. So we're just going to be beating the proverbial bushes regularly and persistently and continuously, because I don't know, me personally, I'm a big believer is, a lot of this is luck, but in terms of finding something, but you got to be lucky. You've got to work very hard to put yourself in a position to be lucky. And I can tell you that if you're just sitting around and you're going to play golf and you're, taking your kids somewhere, and I mean, I'm not taking anything away from that. I definitely do that. But if you're just like taking advantage of this pandemic and like, it's an excuse because, it's uncertain, our perspective, my perspective is, yeah, but that's when the opportunity is. So we are still looking very hard to make further investments on equity and debt. And, when we stand behind the commitment, like Ashesh talked about at Reston, and like nobody else was doing anything, and we stood behind our commitment, and we're hearing other lenders and other equity buyers are like repricing the asset, sort of, well, there should just be a COVID discount. Maybe there should, maybe there shouldn't. I'm not saying we're being, imprudent, but if there's a change, you change the price. If there's no change, Washington gets back. Might be 2 years, might be 4 years, but it's gonna get back. At least history repeats itself, and it's gonna repeat itself again. With structural changes, sure, but if you're uncertain, you're just like a deer in headlights, and business life has to go on, and we're gonna find good investments to make.
Right, definitely. Now, do you think there's one lesson that this crisis has taught us about our industry? Any kind of like key takeaways from the last few months?
That's a good question. I don't think, I'm not sure we've talked about like everything in our office.
Yeah.
I would say one key takeaway is that you can work remotely much better than I think any of us ever thought you could do. And you can also, to some extent, I think it's harder with kids. You can have some distance learning. I think that's kind of age dependent. So I think we've learned that that's possible, but I don't think it's practical because humans need other human interaction.
For sure.
So maybe the lesson is, look, you can make things work, but I don't know what the long-term kind of prognosis is. I don't know. Any thoughts, Shash?
No, I agree with you. I think there's, we go back and forth what is the long-term effect of what the last 3 months have meant for our industry. And I think, we can kind of go to either side of the spectrum, which is everybody goes 100% work from home, or everybody goes back to sort of normal, and you see this increase in office space. I think I don't think the story's been written yet. And one thing we will see, and we have seen already, is landlords and tenants prepare for a new normal where there is some sort of mix of uses, and whether it's having a headquarters office as well as satellite offices. You're seeing that in multiple markets, not just DC, not just New York. So I think it's still a TBD for us what the long-term takeaway is, but it seems like everything's on the table for how our use of office space changes over time.
Right. And how's the experience been for you as a company working remotely? Has it been quite seamless, or how have you found it in terms of closing deals, looking at deals, underwriting deals?
I think that, I don't know, again, some of this is personal observation. I feel like sometimes the Zoom, and we happen to use Teams, it forces you to be more proactive. It forces you to interact more. It forces you to plan your meeting. I'm kind of shocked that meetings start on time. They kind of end on time. And, a lot of times a meeting in the office, it's crazy how late people are. It is harder to physically view buildings, but I don't know, like Ashesh was saying on Reston, frankly, I'm respectful of what's going on with this pandemic, and I'm careful, but I personally don't mind getting out and doing things and working with consultants that have the same perspective, and we just are very careful and very cognizant. So if you have that perspective, that's where we can be successful, because other people maybe aren't. And I'm nothing against what they're, focused on staying at home, but we've got to there's trade-offs with everything, and we've got to sort of focus on continuing to be a viable business and company, and even the economy. So
yeah, for sure. Ashesh, anything to add there?
No, I think Steve said it well. And just going back, just kind of linking it back to the Reston deal, I think it was a good mix of of having familiarity with the property, but also having Steve on the ground in that market for us to feel comfortable in closing that remotely. I don't think if it was a new market for Rubenstein, if we would have had that same level of comfort, or if it was a new property, or if it wasn't a trusted source like Steve, who is giving kind of his thumbs up on the process. So I think that is going to be something I'd be curious to hear from maybe some of our attendees who are in the space, how due diligence is being done at this time, or is it at a standstill at their respective firms?
Right, exactly, yeah. And I think obviously there's the thought of getting a plane is very, very scary to a lot of people just now. So I think it's going to be interesting to see how the next few months play out in terms of, deals getting done and in states where the firms are not in those particular states. So yeah, definitely interesting. Now, apart from the obvious one, is there anything that's keeping you up at night in terms of the near term for our market?
Yeah, I usually get up every night. I go to sleep okay, but I definitely get up in the middle of the night. It's really the leasing and the leasing market. I mean, I think that right now we're also observing, again, kind of at our own portfolio, it's kind of an interesting, like brand new tenants seem to kind of be putting things on hold. So if a tenant hasn't been in the market, it feels like they really are just like waiting. And a lot of those are the bigger public companies. They're like, I have no idea what I should be doing, so I'm just going to sit tight. We're seeing, so what the result of that is, we're seeing some bigger tenants just seeking some short-term renewals. But then we also see sort of small and mid-sized tenants where they don't have the same public corporate governance. We are seeing them kind of come out and look at new space opportunities because they're like, look, I need space. I need to find it. I'm growing. This is good. The pandemic has not hurt my business. And, I want to be in X location. So what it seems is like a lot of the tenants, it's more like what's real. So a lot of the tours where people are kicking tires aren't happening. So I don't know what keeps me up. It's sort of like, okay, how do we get the buildings leased? Because it kind of goes back to your question about to Ashesh about forbearance. A lot of our acquisitions, we capitalize assuming we don't lease them for a while. So we have interest reserves and operating expense reserves. So in many cases, our emptier buildings, we're fine. But those reserves don't last forever. So that's what keeps me up. It's like, when will the tenant activity come back with greater velocity than exists today?
Right. Ashesh, any thoughts?
So I would generally agree with what Steve's saying on sort of a property by property basis. I think we're fortunate being in the lender seat. We've made bets on good sponsors. But you're right, those reserves are things that we keep an eye on. The second, I think just more kind of macro is, I also cover the West Coast for Rubenstein. So for me, it's when is it going to be okay to get on a plane and go visit some of the markets? We're looking at things on the West Coast. So, that's, I think, again, that's something that probably a lot of the listeners here are probably facing is, when is it safe and how do you kind of navigate travel? And I've heard, again, anecdotally, what it's like to travel even on a 50 to 60% full flight. But again, it's that uncertainty that it would be nice to get answered before we get on a plane.
For sure, especially given so many states are spiking now in number of cases again. So it's quite a thought. Now to slightly cheerier news, July 4th is coming up. So any plans? Are you staying, obviously probably staying local, but any big plans for July 4th?
Ashesh?
I mean, hopefully get out and enjoy this beautiful weather and, do something outdoors. The nice thing is that I live in the suburbs, so it's conducive for natural social distancing. But Steve, what about yourself?
Yeah, I don't know. We had a couple colleagues who ventured out from their house earlier this week. Forgot what day it is, right? We all forget what day it is.
Oh yeah, all the days are the same.
But we went and visited one of our properties we have in DC at Union Station, and we've got a really great rooftop deck there. And I said, you guys ought to come down and watch the fireworks, because we have about a 300 and maybe not quite, probably a 300-degree view of Maryland, DC, and Virginia, and you just see and the Washington Monument. So you've got these spectacular views, but then I was like, well, wait a second, there's probably no fireworks this year. So long-winded answer of, I don't know what we'll do. I like that because we get in and out, and as an owner of the building, it makes it a little easy for me selfishly, and take my kids there. But otherwise, I don't know, probably in the backyard with one other family, like all spread out in a circle cooking hamburgers or something.
That doesn't sound too bad.
Yeah, me putting some fireworks out back if we're allowed to in Virginia.
Right. It's interesting with the fires. I didn't think about that. Probably none this year. But well, I hope you have a very safe and happy July 4th. And thank you so much for today. This was an absolute pleasure chatting with you both. And I learned a lot about the DC market and also Rubenstein. So thank you for joining me today. And thank you to all of our viewers also for joining us.
Thanks so much, Cathy. Appreciate it.
Take care.
Take care. What'd you think, Steve?